Now, a recent report from the Australian Banking Association has highlighted the remarkable extent to which Australian payment methods have evolved in the last few years. The ABA's Bank on It Customer Trends 2023 report revealed mobile wallet transactions have skyrocketed to $93 billion, while nearly 99% of bank interactions are now taking place digitally. Also, cards have rapidly replaced cash, with 75% of payments occurring with cards, compared to just 26% in 2007. Now, to tell us more, I'm pleased to say we're joined by ABA CEO Anna Bligh. Anna, welcome to the Savings Tip Jar.
Great to be here.
Thanks for sharing your time with us, Anna. So on sort of what Dom was saying just there, we've seen recently that the government plans to phase out cheques by 2030. So what I wanted to ask you was, what sort of demographics are going to have to be most prepared, and how are banks reacting to this, and how are they getting ready for this sort of change? And sort of off the back of that, is cash next?
So cheques have become a very, very small part of our payment system. They currently account for 0.2% of all payments. But for some reasons, they're still, for some people, quite an important part of the way they do business. So, for example, lawyers who are involved in helping people do their conveyancing on the purchase or the sale of a property, often use a cheque and put that in a trust account for, to hold the deposit on a house, for example. But it's not just in the broader economy. It's also some of the biggest issuers of cheques are still government. There are I understand a number of doctors who still receive their payments through Medicare via a cheque. So as there are so they're the sort of very big users of cheques in terms of volume. But I think there's probably many people listening to your podcast who have never even seen a checkbook themselves or used a checkbook, but they might have got a cheque from their grandma for Christmas. There is an older group of Australians who really value the use of cheques because it helps them keep account of what their spending has been. They feel like it's a safer method than sending cash in the Christmas card, those sorts of things. So I think the challenge for us all is to make sure that we've got the right alternatives in place by the time 2030 comes around. Having said that, I should say that our colleagues across the ditch in New Zealand managed to do this 12 months ago with 6 months' notice. So I think Australians with 7 years' notice will be able to manage this okay. I mean, so for example, on the for older people who might want to use a cheque to send to a grandchild, or they might want to pay a bill with a cheque through the mail, Australia Post already offers a money order product. There is a good, viable, safe, secure alternative there.
Now, and I don't know if you've ever heard this, but I guess some people overseas regard Australia as a bit behind the times when it comes to technology. But I noticed the ABA report has found that Australians have traditionally been very early adopters of sort of digital payments, leading the UK, the US, and many European countries. So, can you explain a little bit about why Australians are such world-leading adopters of new bank tech?
Sure. Just before I do, I realised I didn't say anything on the second part of Harrison's question, which was what were the cash might be next. We're certainly seeing a rapid drop in cash. I think cash is here for quite a long time to stay. But, in the last 15 years, we've seen cash go. It used to, in 2007, it accounted for 70% of how we paid for goods and services. In 22, it accounts for 13%. So the card, cash might have been king once, but the card is definitely king now. Or the mobile wallet or the smartwatch. So, that's the change that's happening. Yes, I think people might be surprised on the one hand to hear that Australians are very early adopters of financial technology. And I think there is a number of things that account for that. Firstly, the nature of our banking system. So in Australia, as people know, we have 4 very large banks. And then we have a number of what you might call mid-tier banks like Suncorp, BOQ, Bendigo and Adelaide Bank. And then we have quite a lot of much smaller financial banking operators such as credit unions and building societies. What that means, one of the benefits to the country of having those big four banks is that they can actually fund infrastructure that will facilitate new technology. So in Australia, the banks actually they developed and funded FPOS. They developed and funded BPay. They own that back of house kind of machinery, if you like. In the US has 4,500 banks.
Wow.
They are, so a lot of Americans or US citizens, they bank with a bank that might only have one branch, and that's in the town where they were, first started. And, that has its own benefits, and some of them really like that, but it does mean they don't have those big pillars in the retail banking sector. They do have big investment banks like the JP Morgans, but the banks that, just provide mortgages and savings accounts and those sort of products to ordinary people, that they are very, very dispersed. So it's much, much harder for them to come together and collectively fund, payment systems. So FPOS was one of the first of its kind in the world. And it's kind of, I think also, we're a country with a relatively small population spread over a very large geographic area. And so, necessity has sometimes been the mother of invention. And Australians as a people are, willing to experiment. And yes, I think it is interesting for those of your listeners who have travelled overseas, and I know we couldn't do it for a little while in the last 5 years, but it's not unusual in a country like the US or even Japan, where you would think they would be much more high-tech than Australia, to still have to pay for something and put your PIN number in. Tap and go is not not a facility that is available in many, many, many parts of those countries. So they're quite a way behind where we are. And we've got a very rapid adoption rate on the mobile wallet.
Sure. And we'll change gears slightly now. So one thing I've noticed the Australian Banking Association has been discussing recently is elder financial abuse. So what exactly is that? What does it look like in practice? And what are banks doing to stop this or at least mitigate this?
Well, it's an absolutely terrible crime, is what elder financial abuse is. It basically it's the use of a trusted relationship to either force people, older Australians, to hand over things like their password and their banking details, or you use the trusted relationship effectively to trick them out of money. And unfortunately, it's almost always a highly trusted relationship. So it's the adult children of an older Australian. It's maybe one of their siblings. It could be the next door neighbour who has been, doing things that appear very friendly, like, going and doing the grocery shopping for them, but at the same time putting their own groceries on the card of the older person who has shared their PIN number with them, or, given them their card to shop with. So often it takes a very long time for the older person to realise that they are being sort of ripped off here. It can be much more serious than that. It can be people deliberately, forming a relationship through things like, oh, let me help you with that, let me help you with this. And then literally, oh, can you just sign this? And without knowing it, the older person has signed over their entire life savings to somebody. So as I said, it ranges from family members, and it's particularly tragic in those circumstances because, as you can imagine, it is very, very hard for someone to accept that their adult son or daughter has been systematically abusing them financially. And I think there's probably in some family members, particularly where they're helping to care for an older person, some people come to have a sense of entitlement. I'm sort of sacrificing parts of my life to look after mum or dad. and therefore I'm owed something. So in terms of what banks can do, there are a number of things. Well, firstly, that people can do to protect themselves. And, some of your listeners may be getting to an age where they need to be thinking about, if I get to a point where maybe I'm not so good at looking after my own finances, who would I really trust to do that for me, and to appoint that person as your power of attorney at the right time. Banks have very sophisticated data analytical capability predominantly because of tap and go. They can see what you're buying and when you're spending, and they have huge, data analytics that can, go right across every transaction. And what that means is when they see something unusual, they can flag it. And it's, I'm sure you've had in your time, or many of your listeners will, you've been traveling overseas and, spending in a foreign country, and you'll get a message from your bank. There are transactions on your account occurring in Barcelona. If this is not you, please call your bank. That's because they've noticed suddenly there's this very unusual pattern happening. That's just one example. But when they see, for example, somebody whose only income has been, sort of the age pension, they might be someone who's, has money in an account because they've sold a property or something, but their income is very relatively small, and that their expenditure, mostly all they spend is a little bit of money on groceries and a few beers at the pub on Saturday night. And suddenly they've bought, a really expensive skiing trip, in Europe for 5 people. They can ask questions. They call and make sure. Now, there can be a very good reason. It's perfectly reasonable for grandma to decide to shout the grandkids, a big Christmas holiday. There's nothing wrong with that. But if banks see something unusual like that, they now have a much better ability to reach out and say, this is an unusual expenditure. Are you okay? Did you authorize this, etc.? But there are a range of things that we need the government to do, and banks have been, pushing very hard for. At the moment, there is no national register of powers of attorney. So bank staff, it can be hard to know. There's no way of checking if somebody's power of attorney document is legitimate, if it's still current, if it's been cancelled. So some of the protections need to be increased. I think we've got more and more Australians living longer and longer, and these issues are going to become more and more prevalent for more of them.
And just, bringing up another rather unpleasant topic, which you touched on briefly earlier, just on scams at the moment. It seems like, for all our advancements in banking technology, banking scams seem to be at an all-time high. And, you mentioned how, banks are blocking transactions that they see overseas that seem unusual for that person. But I've heard of a lot of people who've suffered from that lately, had several large transactions made on their account in New York or whatever. And the bank has been too slow to stop those transactions. And by the time that person brings it up with the bank, they're told it was their fault. So, I mean, what are banks doing to stop these scams, and are they going to try and change their way of sort of reimbursing people? Because I see, reports coming out that current rates of reimbursement are only around 2 to 5%, which doesn't seem like much to me.
Well, thank you for the question. And you're right, we are seeing a rapid escalation globally in the incidence of scams. Part of this is a consequence globally of more and more people banking in that digital environment. It's not the only thing, though. We are seeing increasingly sophisticated, globally active criminal gangs who have the capability, because of advances in technology. For example, I'm sure you've had that message on your phone that says you owe money to the toll company. These gangs can,
on a weekly basis,
yeah, but they generate that message and can get it out to millions of phone numbers. And for them, they just know that the more they push out of those messages, somebody's going to fall for it. And millions of people don't. They say, oh, yeah, that's a scam. That's stupid. Get rid of it. They only need, hundreds of people to fall for it, not millions, and they're still making money. But there is a distinction, I think, to be made between what the industry would describe as a fraud versus a scam. If the customer has not authorised the payment and had no place in money disappearing from their account, the banks would regard that as a fraud and they would make good that customer. What we would term a scam is where the customer has themselves authorised the payment. Someone has done something to trick them into authorising the payment. And so there are some circumstances in which banks would reimburse that. But where customers have actually said, it's a romance scam, for example, I'm sending money to someone who I believe to be, a potential life partner, only to find that they've been grooming me for 3 months and I've just sent a lot of money to Nigeria and it's not coming back. I think there's a pretty legitimate question about whether or not a bank is liable for that. Then there's the kind of minor ones that we've just talked about, like, pay my toll. Again, if somebody has answered, clicked through on a URL link in a text message and made and authorised a payment, that is, they've actually, when you press, pay in your bank account, you are instructing your bank to make that payment. So banks are actually getting much more sophisticated at being able to interrupt some of that and come to you and say, we think this is, you're being scammed, but they can't stop everything. So, some of this is about taking personal responsibility for how careful we are with protecting our passwords, thinking twice about the kind of payments that we're making and being really careful about whether or not it's a legitimate organisation that we're paying to. But one of the conversations banks are having at the moment, we've worked very hard in Australia to develop a payment system that is very fast, very efficient, lots of innovation, and that now processes payments in real time. And many of your listeners will recall it's not that long ago where when you made a digital payment, it would sometimes take 3 or 4 days before it got to the recipient. That now happens in real time. And the system, banks are actually now thinking about and talking to regulators that maybe we need to put more friction back into the system. Maybe we do need to think in some circumstances where it's so for example, where it's someone you've never paid before, should that money not be processed for 24 hours, for example, just to give you and the bank time that if you realise, I don't think that was right, for them to be able to stop it and before it gets into the hands of the scammer. So, there are a lot of things that banks, given how quickly scams are rising, banks are looking to do whatever they can to make the system safer. In fact, the amount of money banks are now spending on technology, including software in this space, is 8 times more than they spend on bricks and mortar branches, because that's where their customers are and that's where that's the space they've got to keep safe. So banks will, where there has been a fraud, where their systems have failed, they will reimburse customers. But where customers have authorised the payment, unless there's some other exceptional circumstance, remember the money that banks have is your money. It's the money out of your deposit account. That's the money banks use. So if we had a system where banks used your money to reimburse every customer that had authorised a scam payment, I think we'd end up with some real problems in the system. But what is happening to people is, there's some absolutely heartbreaking experiences that people are having. And I think one of the other issues that's very important to remember, or for us to think about, and we're talking to government on it, banks don't know anything about a scam till it comes out of your bank account. Most people get a scam through their phone or through a social media platform, through Instagram, through Facebook, or they go Googling to look for investment opportunities. And they end up, unfortunately, finding a company that's very dodgy. So it's actually an ecosystem that scammers are exploiting. We've got to do everything we can to make our telecommunication systems more resistant to those kinds of messages so that people don't get them in the first place. We've got to make sure that the social media platforms are not advertising investment companies that aren't real, that are fake, where we can prove that they're fake. And we've got to make sure that banks continue to invest in the safety of their system and improve their ability to recover funds when a customer makes a mistake and sends it to a scammer.
We'll move to sort of the next chapter now, and we'll have a couple of questions for you about home lending. So there's the big R word that's sort of on a lot of people's lips in the next 12 months, and that's recession. Now, we had a recession during COVID, and in that time, we saw that the Reserve Bank lent at near zero interest rates $188 billion to banks. The major banks, so CommBank, NAB, ANZ, and Westpac, were the biggest recipients of this $188 billion. And this was because there were genuine fears in the market at that time that the lending, that credit could collapse during COVID. Now, at near zero interest rates, does this create a sort of moral hazard? Australian banks, especially the big four, are they too big to fail? And how are these banks preparing for the next recession with this context in mind?
There's a lot in that question. I should say in relation to that temporary funding facility, there was a requirement that it be paid back, and banks, any bank that accessed that money at those low rates, which the Reserve Bank at the time, with the information they had available, thought was important, as you said, to be funding into the economy, partly because they were very concerned that businesses, particularly small businesses, might need cash flow support as the economy started to collapse potentially. Now, in the end, a combination of government support during COVID, but also the support that banks gave their customers. So banks gave customers deferrals on their loans, both their housing and their business loans. And I think the combination of those two things really kept Australia very strong during that time. That temporary funding facility, I think, should be seen as a very extreme measure in very extreme circumstances. And banks certainly wouldn't expect to see that sort of funding from the RBA in anything other than the most extreme cases. And as I said, they are required to pay it back, and most of them have. There's a repayment plan it's well and truly underway. I think they're getting very close to having finished that payback. But then they have to go back, to the market to replace that money. And of course, the market is pricing money at a much higher rate than those very, very low rates during those extreme times. So I think it's hard to judge a system on what happens during those really extreme moments. But I should say Australian banks did not access any other support, that none of them needed or accepted or took any money, for example, out of JobKeeper. I think if any of our banks had needed to access JobKeeper, we would have all been in real trouble. So, it's a good thing to have strong banks, and the country, we are very, I think, lucky in this country, having watched a couple of significant banks fail in the US and in Europe in the last 3 months. We can, I think, touch wood and thank our lucky stars that we have a strong, well-capitalised, well-regulated banking system. But that requires constant vigilance. So in terms of, lending in Australia, we have, I said banks are well-regulated. There's quite a lot of regulatory requirements about how banks lend and how they make sure before they lend that people can meet their payments and service the loan through economic cycles. And right now we're going through a really tough cycle.
Just expanding on that a bit, Anna, that last point you made, and just quickly, because we are starting to run out of time, I'm afraid. We have seen APRA come out with some warnings about banks loosening their serviceability assessments, namely, the 3%, 300 basis point buffer. What do you think? Are banks making too many exceptions to this rule?
I might just explain what the buffer is for some of your listeners.
Yeah, go for it.
Banks are required, when they are assessing whether or not to give you a loan, they're required to look at your income, look at your expenses, and determine if you can meet the repayments. Then they are required to add 3% to the interest rate that they propose to charge you, just to see, as an exercise, if interest rates went up 3%, could you still make those payments? So they don't add 3% to your actual loan. They add it to it's an exercise in working out, in calculating your ability to service through the economic cycles that might come and go during the time you have the loan. So banks think that the serviceability buffer is actually a really important part of the credit assessment process. They actively support it, and they use it all the time. There are, however, always some extenuating circumstances, and this is recognised by APRA and their guidance and banks. So, for example, right now, where interest rates have gone to a much higher place than they've been for more than a decade, if banks had a customer that wanted to refinance a loan to a lower interest rate, if banks applied the serviceability buffer strictly in that case, the customer may not meet the requirement. So you end up with this crazy situation where a customer who might be really feeling the pinch can't access a lower interest rate because theoretically they can't service it. So banks are saying in very limited circumstances, that is, this is a customer that you've had for a long time, they've never missed a payment, they are a good credit risk, you know them and you know their performance, they are applying for the same loan for the same house at a reduced rate, then there should be some flexibility in the use of the buffer. Otherwise, you just end up with a very perverse outcome that, in order to protect someone, you've locked them into a higher payment. And I don't think anybody thinks that's a good idea. So there may be a few more of those kinds of circumstances in the current environment, but they need to be applied very prudently, very diligently and very carefully. And as I said, banks are not, they're only using that flexibility around the buffer in those very tight set of conditions. If you went into a bank as a new customer tomorrow, they would apply the serviceability buffer in full to you. And I should say it's not just on mortgages, they're required to do that on personal loans, car loans and other things. So they value it as a part of the credit assessment, because if you're taking out a 5-year loan or a 10-year loan or a 30-year mortgage, they know that there's going to be economic ups and downs. There's going to be increases in groceries and petrol and fuel prices and school fees during the life of that loan. And they want to know that not only can you service it at a stretch, they don't want you to be totally stretched, I suppose is what I'm saying, because they know there'll be other things that come along. And it's a good thing for you and for them in their risk assessment that they know there's a bit of wriggle room there.
For sure. And Anna Bligh, I'm afraid that's all we have time for on the Savings Tip Jar podcast. Thanks for going through a whole mix of a range of questions and answering what we threw at you. We appreciate your time once again.
Great. Thank you very much. Thanks, Harrison.
Cheers.
Thanks, Dom.